I want you to picture the physical reality of modern global finance.
Oh, yeah. It's intense.
Right. Like when you think of billions of dollars moving across exchanges, whether that's traditional equities or crypto, you probably picture this, I don't know, this high-speed arms race.
Yeah, financial firms literally fighting over the physical length of fiber optic cables.
Exactly. Just to shave a single microsecond off a trade. In the current setup, we have these massive data centers packed with servers, and they're all connected by these thick black cables trying to coordinate the entire global market in real time.
Which is wild when you think about it.
It is. It's incredibly complex, but honestly, it's a little clunky.
Yeah, it is surprisingly physical for a digital world. We throw around terms like the cloud and, decentralized finance. But at the end of the day, all that capital is currently bottlenecked by the physical laws of distance.
Right. Hardware handshakes and glass tubes.
Exactly. It literally comes down to how fast a packet of data can travel down a glass tube.
And that physical bottleneck is exactly what we are blowing up today. So welcome to the Deep Dive. Our mission today is to explore a massive, almost invisible shift happening right now in how markets fundamentally function.
The total paradigm shift.
Yeah, we're moving away from this chaotic, high-frequency ping-pong match across physical servers. Instead, we're heading toward a system where an entire global market lives on a single, microscopic piece of silicon.
Which sounds like science fiction, but it's happening.
It really is. And our guide for this journey is a phenomenal blog post from March 2026 by Kyle Samani. It's titled PropAMMs, The Future of Market Microstructure.
Samani's core thesis here is a really bold structural prediction. He argues that a decade from now, we will look back on the history of trading and see it in three very distinct evolutionary phases.
Okay, lay those out for us.
So first, there were pre-electronic CLOs, that's central limit order books. Think of the classic trading pits, guys in jackets yelling and waving slips of paper.
Right, the chaotic movie scenes.
Exactly. Then second, we have electronic CLOs. That's the system you just described, the current status quo of data centers, servers, and cables.
Yeah.
And finally, we are entering the third phase, which are PropAMMs.
Okay, let's unpack this, because before we can really grasp why a PropAMM is such a massive technological leap, we have to establish the baseline.
Yeah, we have to look at the plumbing.
Right. We need to look closely at how the dominant centralized exchange model, the CEX model, actually operates today. And we are talking about the giants here.
The heavy hitters.
Yeah, traditional finance and crypto, the NYSE, NASDAQ, CME, as well as Binance, Coinbase, Bybit, all of them.
To really understand the CEX model, you have to look at the geography of a trade.
Geography.
Yeah, physically. You have the exchange itself, which runs a central matching engine, and then you have market makers. These are the firms whose entire job is to provide liquidity.
Meaning they're always there to buy or sell.
Right. They are constantly offering to buy or sell an asset so that when you want to trade, there's always a counterparty. But to be as fast as possible, these market makers physically co-locate their servers with the exchange.
Oh, so they literally rent server rack space in the exact same physical warehouse as the exchange's matching engine.
Precisely. So you'll have dozens of competing high-frequency trading firms in one room, and each firm is running its own proprietary pricing algorithm on its own dedicated server.
Okay.
And here is the critical part. To keep things fair, the exchange mandates that all of these different market maker servers connect to the central matching engine using cables of the exact same length.
Wow, really?
Yeah, usually that's a standard 50-meter cable. So you have a central hub tethered to dozens of competing servers by 50-meter cables.
That is wild. And the inefficiency loop that this physical setup creates is just what's staggering.
Oh, it's a mess.
Let's trace a standard trade. Say a retail taker like, just a regular person looking to buy at the current market price hits submit on an order. That order hits the central exchange. The exchange processes it and immediately has to broadcast the new state of the market. It has to announce the new top-of-the-book price out to every single market maker in that room.
Right. It shoots that data packet down dozens of 50-meter cables simultaneously.
Then, every single market maker's algorithm receives that packet. They have to process the new info, calculate their risk, reprice their assets, cancel their old orders, and then generate new limit orders.
Which takes, real computational time.
Exactly. And once they've done that math, they fire all those updated orders back down the 50-meter cables to the central exchange.
And it just bottlenecks.
Yeah. The exchange then has to process this massive wave of incoming changes, update the master ledger, and broadcast the new reality back out again. And the sequence repeats infinitely, like every few microseconds.
What's fascinating here is that this massive messaging volume, this constant inter-server handshake and broadcast storm, is exactly the inefficiency that the next evolution solves.
Because most of it isn't even real trading, right?
Exactly. You have a system where the overwhelming majority of network traffic isn't actual trades. It's just market makers constantly updating and canceling quotes in reaction to each other.
That's crazy.
And the ultimate bottleneck is the physical space. The network interface cards processing all that chatter are just maxed out.
I mean, it's essentially like being in a 50-person group text where everyone is trying to organize dinner at the exact same millisecond.
That's a great way to put it.
Right, like every time one person types a suggestion, 49 other people have to read it, delete the text they were currently drafting, and type a new response based on the new information over and over.
It sounds exhausting.
The sheer amount of wasted energy and network traffic is absurd. Why do we even need this physical separation in 2026?
Well, we don't anymore.
Which brings us to the breakthrough. We are eliminating those 50-meter cables entirely. Let's talk about the PropAMM.
Yes, proprietary automated market-making algorithms.
Right. And right now, this breakthrough is happening directly on the Solana blockchain.
This is where Samani's piece really shines. The paradigm shift is entirely structural. In the old electronic silo model, the exchange is on one server, the market makers are on different servers, and they communicate across those physical cables.
Okay.
In the PropAMM model, the exchange itself hosts the market makers' pricing algorithms.
Wait, so they are completely merged? The venue and the participant are living in the same house?
That's the leap. On Solana, the mainnet itself acts as the exchange. And instead of the market maker sitting in a data center 50 meters away, they deploy their proprietary pricing algorithm directly onto the blockchain as a smart contract.
Oh, wow.
Both the matching engine of the exchange and the market-making algorithms live on a single piece of silicon.
To really drive this home for you listening, let's look at the mechanics of a trade in this new system. We have what's called a virtual machine.
Right, which is essentially the software-based computer running on the blockchain.
Exactly. When a regular trader's order arrives on Solana, it lands in the exact same virtual machine that is already running the PropAMM's pricing logic.
They're roommates, basically.
Yeah. Because they are sharing the exact same computational environment, the market maker's algorithm can instantly read the on-chain state.
Without any lag.
Right. It can look at its own current inventory, it can look at the last trade, and it can look at Oracle price feeds, which are just the external sensors that tell the blockchain what the real-world price of an asset is. It reads all of this and updates its quotes instantly.
Without its logic ever leaving the chip. Samani phrases this beautifully in the source. He says, the electrons only have to move inside a single piece of silicon.
That visual is incredible. Just a single piece of silicon. There are no external data packets being sent back and forth.
No.
There are no network interface cards trying to decode signals. There's no broadcast storm crashing the network.
None of it.
And the source points to a real-world application of this with a protocol called DFlow, which recently introduced JIT, or just-in-time routing.
Oh, JIT routing is huge for this.
So if I'm understanding this correctly, JIT routing takes advantage of this shared environment so that the moment a user's order arrives, the system queries all the PropAMMs simultaneously and instantly gives the user the absolute best fill available. Is that right?
You're understanding it perfectly. Because there is no broadcast delay, the taker gets incredible pricing.
Because it's happening in real time.
Exactly. The result for you, the retail trader, is tighter spreads. And a tighter spread simply means the gap between the buy and sell price is smaller, so you keep more of your money.
I think everyone likes keeping more of their money.
Right. And for the network itself, eliminating that broadcast storm results in a 90 to 99% reduction in aggregate message load.
99%.
Up to 99%. The system is dramatically quieter, vastly more efficient, and fundamentally cheaper to operate.
Okay, but wait. I'm looking at these speed claims, and something just, it doesn't add up for me.
What do you mean?
Well, the hard data from the source is clear. PropAMMs are already the dominant quoting mechanism for spot SOL USDC trades on Solana.
Yep, they're dominating.
And they're delivering tighter spreads than major centralized exchanges with billions in daily volume. And it's happening for ETH too. But critics always point to the underlying speed of the blockchain itself.
Ah, the slot time argument.
Right. Solana's slot time, the time it takes for the network to produce a new block, is around 400 milliseconds.
Correct.
But traditional Wall Street finance operates in microseconds, millions of a second. How is comparing a 400 millisecond blockchain to a microsecond data center not like bringing a bicycle to a Formula One race?
That is the most common critique, and honestly, it sounds entirely logical until you break down the actual mechanics of a trade.
Okay, break it down for me.
Samani provides a brilliant deconstruction here. The critics are conflating two entirely different metrics. They are confusing global network consensus latency with algorithmic repricing latency.
Let me make sure I have this. So global network consensus latency is simply how long it takes for the thousands of independent computers around the world that make up Solana to agree on a new block and finalize it. And we know that takes roughly 400 milliseconds. But the algorithmic repricing latency is different.
Radically different. Algorithmic repricing latency is how fast a market-making algorithm can react and change its price after receiving new information.
Oh, I see.
And because the market maker and the exchange are sharing the exact same virtual machine, the system clock is shared. Trading information is available to all the market-making algorithms instantly.
So it's essentially the difference between doing math in your head versus publishing a textbook.
That is a perfect analogy.
Like, if you need to know what 2 plus 2 is, you can calculate it instantly in your brain. That's the algorithmic repricing.
Yes.
You don't have to wait for a publisher to print and distribute a math textbook to the entire world, which is the global block finalization, to know the answer is 4.
Exactly. The 400 millisecond slot time is completely irrelevant to the market maker's critical path because they are doing the math instantly on the chip.
That makes total sense.
The information propagation delay inside that critical path is effectively 0. They aren't waiting for the entire globe to reach consensus.
Right. They are executing their logic based on the state that is immediately present in the virtual machine.
Precisely.
Okay, but we have to look at the current hurdles because PropAMMs are only about a year old.
Right. Yeah, very new tech.
If this architecture is fundamentally superior, why hasn't every single trade in crypto migrated to this model yet?
Well, there's a catch.
Yeah, the source points out one meaningful flaw in the system right now. It says takers currently lack a deterministic best execution guarantee across multiple PropAMMs.
Right. To understand this flaw, we have to remember that these algorithms are proprietary. They are fiercely private, which, makes sense.
Sure, they're protecting their edge.
A quantitative trading firm is never going to publish the secret mathematical sauce they use to price an asset. But because those algorithms are hidden from the public, the routing logic across these different PropAMMs is non-deterministic.
Meaning you can't perfectly predict the outcome.
Exactly.
It's like knowing there are 5 secret stores in your town, and they all offer incredible, constantly changing discounts on the exact same item.
Right.
But you don't have a reliable map. You can't guarantee that you'll walk into the absolute cheapest store first. You might walk into store number 2 and get a fantastic deal.
But you have no way of knowing definitively that store number 4 wasn't a fraction of a cent cheaper at that exact microsecond.
That's the exact problem. So without deterministic routing, the user takes on a slight execution risk.
They do. But Samani points out that this problem is highly tractable, and the solution lies with aggregators.
Okay, tell us about aggregators.
Aggregators are platforms like Jupiter or dFlow for spot trading, and various emerging routers for perps that sit between the user and the market makers. They scan the network to find you the best price. And the key dynamic here is that the aggregators hold all the cards.
Oh, because they control the order flow.
Exactly.
The aggregators are basically the bouncers at the club. The PropAMMs depend entirely on these aggregators to bring them customers.
That's spot on.
If an aggregator decides not to route trades to your specific algorithm, your algorithm just sits there doing nothing, making 0 money. So the aggregators have the leverage to dictate the rules of the game.
Yeah. And because of that massive financial leverage, Samani expects that by the end of 2026, these aggregators will force PropAMMs to adopt formal best execution primitives.
Like what kind of rules?
We are talking about strict rules like price priority routing, simulated fills where the aggregator can essentially test the price before committing the user's funds, or requiring on-chain commitments that guarantee the quote.
Wow, so they're forcing them to play fair.
If we connect this to the bigger picture, what we are witnessing is a classic technology adoption curve. The raw engine of this technology, the PropAMMs living on a single piece of silicon, has vastly outpaced the steering wheel, which is the routing infrastructure.
But because the financial incentive is so massive, the steering is catching up quickly.
Very quick.
And what's wild is that while the aggregators are busy fixing the steering wheel, The underlying road they were driving on is being entirely rebuilt to handle more traffic.
Yeah, the network itself is leveling up.
Because if the routing gets fixed and everyone suddenly rushes to use these on-chain algorithms, the current blockchain infrastructure would just choke.
It would.
Which is why the source outlines a massive roadmap of upgrades coming to Solana in 2026, specifically designed to supercharge this ecosystem. Let's dig into how these actually work.
The 2026 roadmap directly targets the remaining computational constraints. The first major upgrade is a push for higher compute unit limits and larger transaction sizes.
Okay, compute units. That's basically the budget for how much math an algorithm is allowed to do in a single transaction, right?
Exactly.
By raising that limit, a market maker isn't restricted to simple arithmetic. They can deploy highly sophisticated, computationally heavy pricing models, maybe even incorporating real-time AI risk assessment directly on the chain.
That's the goal. The more complex the math you can run on chip, the tighter your pricing becomes. The next massive upgrade mentioned is Alpenglow, which is slated for around August.
Alpenglow, I love that name.
It's a great name, and it's a software optimization designed to dramatically compress the global latency we talked about earlier. It's aiming to drop those 400 millisecond slot times down to somewhere between 100 and 150 milliseconds.
Which means the textbook gets published 4 times faster, even though the math in your head is already instant?
Yep. Then there's Double Zero, which is another upgrade focused on squeezing out any remaining global network delays.
But the one that really stood out to me was application-controlled execution.
Oh, that one is huge.
It fundamentally changes how market makers protect themselves. It allows them to define custom ordering rules for their algorithms. They can build in guarantees for maker cancels, or even establish taker speed bumps.
Right. And speed bumps are a fascinating concept borrowed from traditional finance.
Yeah, they work.
A taker speed bump allows a market maker to intentionally delay an incoming order by a tiny fraction of time. They do this to protect themselves from toxic flow.
Which is when a highly sophisticated trader is trying to exploit a tiny price discrepancy based on breaking news before the market maker has had a chance to update their quotes.
Exactly. By giving market makers these precise defensive tools on-chain, you give them the confidence to deploy massive amounts of capital.
That makes sense.
Finally, the roadmap includes multiple concurrent leaders, which is a structural change to ensure that a transaction will be included in a block no matter how congested the network gets.
So what does this all mean? Like, if you are listening to this and you aren't running a high-frequency algorithmic trading desk out of your garage, why does any of this matter to you?
It matters because it provides the technical foundation for Samani's boldest prediction,
Which is?
that the Solana mainnet will rival and potentially surpass all traditional centralized exchanges for spot and perps by the end of 2026.
That is massive.
For the listener, this means the fundamental plumbing of global finance is being ripped out and upgraded. It is becoming transparent, frictionless, and incredibly efficient.
It's democratizing it.
Exactly. What used to require millions of dollars in data center real estate, specialized hardware, and armies of network engineers is being compressed into elegant software running on a shared public ledger.
It effectively democratizes access to institutional-grade market efficiency.
The razor-thin spreads and instant execution that used to be the exclusive privilege of Wall Street insiders with the shortest 50-meter cables, well, that will be available to anyone with a smartphone.
We started this deep dive looking at a highly physical room, a heavily air-conditioned warehouse in New Jersey, packed with humming servers, tangled webs of fiber optic lines, and just an endless, chaotic broadcast storm of data packets.
Bouncing back and forth millions of times a second.
Right. Just to figure out the fair price of an asset. And we've traced how that entire chaotic room is being mathematically collapsed down into a single virtual machine.
It's beautiful, honestly.
We are moving away from the brute force of 50-meter co-location cables and entering an era defined by the elegance of pricing algorithms sharing a single piece of silicon.
Absolutely.
Here's where it gets really interesting. If complex market-making algorithms, which, let's face it, required some of the most intense, split-second, high-stakes logic on planet Earth, can now live entirely on-chain inside a single shared state, what other massive human systems are next?
Ooh, that's a good point.
Think about the friction in our physical world. If the future of global financial microstructure is purely algorithmic and localized to a single chip to completely avoid the latency of physical distance, How long until other massive networks follow suit?
Right.
How long until global supply chain logistics or complex energy grid distributions or even global telecom routing adopt this exact same single silicon architecture to eliminate their own physical broadcast storms?
This raises an important question about the very nature of physical infrastructure. Once a system conclusively proves that physical distance is an obsolete bottleneck, that you don't need separate servers shouting at each other across cables to reach an agreement, every single data-heavy industry will eventually have to take notice.
They won't have a choice.
No, they won't. Finance is simply the first domino to fall because the monetary incentive to be the fastest is the absolute highest. But the architecture itself is universally applicable.
The invisible systems running our world are shrinking down to the atomic level, and the physical constraints of the past are being rewritten in software right beneath our feet.
It's a fun time to be watching this space.
It really is. Well, thank you for joining us on this deep dive. Keep questioning the infrastructure around you. Keep looking for those invisible systems, and we'll see you next time.